Hello everybody. At this time we are talking about asset allocation. Asset allocation is how investors divide their portfolios among different assets that might include equities, fixed income assets, and cash and its equivalents. Investors ordinarily aim to balance risk and rewards based on financial goals, risk tolerance, and investment horizon. And then we move to factors affecting asset allocation decision. When making investment decisions, an investor's portfolio's distribution is influenced by factors such as the first, goal factors. Goal factors are individual aspirations to achieve a given level of return or saving for a particular reason or desire. Therefore, different goals affect how a person invests and risks. And then second, risk tolerance. Risk tolerance refers to how much an individual is willing and able to lose a given amount of their original investments in anticipation of getting a higher return in the future. For example, risk-averse investors withhold their portfolio in favor of more secure assets. In contrast, more aggressive investors risk most of their investments in anticipation of higher returns. And then third, time horizon. The time horizon factors depends on the duration an investor is going to invest. Most of the time, it depends on the goal of the investment. Similarly, different time horizons entail different risk tolerance. For example, a long-term investment strategy may prompt an investor to invest in a more volatile or higher risk portfolio since the dynamics of the economy are uncertain and may change in favor of the investor. However, investors with short-term goals may not invest in riskier portfolios. And then, why is asset allocation important? Asset allocation is significant for several reasons. The first reason about risk management. Diversifying across asset classes mitigates overall portfolio risk and prevents dependence on a single asset class. And then second, achieve goals. Strategically distributing investments aligns with your risk-taking ability to achieve your goals. And then third, enhance returns. Allocate assets according to goals and risk tolerance for better risk-adjusted returns. And then we move to the role of asset allocation in achieving financial goals. A well-structured asset allocation strategy helps investors meet their short-term and long-term financial goals. These may include about the first, retirement planning. Younger investors can afford higher stock exposure, which should be shifted toward bonds and other income-generating assets to reduce risk as retirement nears. And then the second, income generation. Retirees or those seeking passive income might prefer dividend-paying stocks and bonds. And then third, wealth preservation and capital protection. Investors focus on capital preservation, allocate more to bonds, cash, and real estate. Without proper asset allocation, an investor might take too much risk or too little risk. And then we move to the relation between asset allocation and diversification. Diversification is a technique that involves investing your money in a variety of different investments in the expectation that if one investment loses value, the other investments can compensate for the loss. Investors usually employ asset allocation to spread their holdings across asset categories, but some may intentionally avoid this. For instance, investing solely in stocks for a 25-year-old preparing for retirement or investing solely in cash equivalents for a family planning for a deposit on a house may be a reasonable asset allocation approach under specific conditions, but neither strategy attempts to minimize risk by holding different kinds of asset categories. Selecting a specific asset allocation strategy may not guarantee portfolio diversification. And then we move to the types of asset allocation. The first type, strategic allocation. This is a long-term plan where you decide how much to invest in each asset class based on your risk profile and stick to it. And then the second, dynamic allocation. This approach is more flexible. Your investment proportions change depending on your life stage or market conditions. It's ideal for those who want professional help managing their portfolio. And then third, tactical allocation. Here, you make short-term adjustments based on market trends. For instance, if the stock market is booming, you might temporarily invest more in equities. And then we move to the three main asset classes. The first class about equities. Familiar to most investors, equities typically offer the potential for higher returns but with higher risk. Typically, equity exposures come via direct stocks, unlisted managed funds, and listed investment companies. And then the second, bonds. Often less well understood, bonds play an important part in diversifying your portfolio and helping to balance the risk of your growth assets. Fixed income exposures historically have provided a lower return than equities. And then third, cash. Under the mattress or in a bank account, these investments will be very low risk but also may not give you much return. And then, how can investors implement asset allocation? Professional investment managers help investors implement asset allocation using two methods: strategic asset allocation and tactical asset allocation. By using both in combination, the manager sets the long-term course for the portfolio and responds to short-term market drivers. Strategic asset allocation, which provides the long-term focus for a portfolio, is based on three key factors: investment objectives, risk tolerance, and time horizon. Depending on the return targets and the level of risk that investors can tolerate, portfolio may be labeled as conservative, income and growth or high growth. I think it is enough. Thanks for watching.